Welcome to the Ellsworth Advisors monthly update for March 2025. I'm Kelly Keenan. This is Cameron Mealy. And today we'll start off with some latest economic numbers, what's going on there, and also talk about the pending tariffs that are going to be potentially implemented today or tomorrow. We'll see what happens there. And then how our portfolios have performed so far this year. Cameron, let's kick it off with some economic stuff.
Perfect. Thank you, Kelly. Hello, everybody. Let's start first with the Fed and what we've seen over the last month. On March 19th, the Federal Reserve announced that they were holding their Fed funds rate consistent at 4.25 to 4.5. This is not a surprise. The level has stayed pat since the Fed announced a 25 basis point cut December 18th. Some of the things in holding rates steady that the Fed cited were the FOMC downgraded its collective outlook for economic growth and gave a bump higher to its inflation projections. Officials now see the economy accelerating at just 1.7% pace this year, down 0.4 percentage from their last projections in December. In addition to the rate decision, the Fed announced a further scaling back of its quantitative tightening program, in which it's slowly reducing the bonds it holds on its balance sheet. And now the consensus on Wall Street is that inflation obviously is still elevated. There is a lot of talk that maybe inflation is not as accelerated as the headline numbers that we keep seeing, but at least the consensus on Wall Street is for likely 225 basis point cuts to the Fed funds rate, likely in the second half of the year.
I'm kind of reading the same thing and kind of in that same camp. I think we're going to finally see the short-term rates come down at some point. The Fed, obviously, inflation, as Cam mentioned, they're concerned of it being higher. Obviously, with new tariffs potentially coming on or are going to be coming on, that will raise prices for a lot of goods and services. But then again, a softer economy also means less demand, which takes pressure off of inflation. I've been reading different things that are showing that inflation is probably coming down. What the tariffs do to bump it up temporarily, we'll see. But bottom line, we'll probably see some Fed cuts on the short-term rates, which I think will make the whole rate environment more normalized, where we have short-term rates in the 3s, longer-term rates, 10-year, 30-year in the 4s. Okay, that's actually a healthy yield curve, so see what happens.
So let's jump into that inflation discussion. And again, this needs to be taken with a grain of salt because these headline numbers are significant. But when you really peel back the data and you look at the overall economy, there's definitely some slowness, which should reduce inflationary pressures. But let's just go through the numbers. The Personal Consumption Expenditure Index, obviously often quoted as the Fed's leading gauge of inflation. On March 28th, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.8% in February. For the 12 months ending February, the index is up 2.8%. This compares to 2.1% in September, 2.3% in October, 2.6% in November, 2.4% in December, and 2.5% in January. So obviously a little bit of a higher trend than what we've seen over the last several months. The Producer Price Index. On March 13th, the Bureau of Labor Statistics reported that the Producer Price Index was unchanged in February. This after a 0.6% increase in January. However, on a year-over-year basis, PPI is up 3.3%. So again, on headline news, significantly higher than the Fed's target rate of 2% inflation. The Consumer Price Index. On March 12th, the Bureau of Labor Statistics also reported that the Consumer Price Index increased 0.3% in February. This was after increasing 0.5% in January. And on a year-over-year basis, the index is up 2.8%. So again, we're seeing the three major inflationary gauges above the Fed's target of 2%. But as you alluded to, the talk behind the scenes are this is more headline numbers and there's less substance to the actual thought that inflation is really running rampant or way ahead of where the Fed wants to be. What's really going to drive that? What's going to drive that is the economy. Let's turn to jobs report. In February, it was reported by the Bureau of Labor Statistics that the U.S. added 151 jobs in February. The unemployment rate remained neutral in February. The March jobs report will come out this Friday, April 4th. And already we're seeing, according to U.S. News Report, the U.S. is expected to add 140,000 jobs in March. Again, this is according to U.S. News and World Report. This is from earlier this week. However, this morning, April 2nd, we found out that ADP, they published their survey of employers. They're projecting the U.S. will add 155,000 jobs in March. So the job picture is still relatively strong.
It's been fairly stable. We're not seeing it falling off a cliff or anything, so that's positive. We want to talk about GDP a little bit.
Yes, let's talk about GDP. On March 27th, the Bureau of Economic Analysis confirmed that according to its third estimate, which really is a more final estimate, GDP in the fourth quarter increased at an annualized rate of 2.4%. This is a decline versus 3.1% increase in the third quarter. Full year GDP in 2024 increased at 2.8%. So good, strong, healthy number. And now we turn our attention to the first quarter, which has created a whole lot of noise. Everybody's kind of scrambling to really figure out what this means. I've often commented on the Atlanta Fed has their projected model called GDP Now. This is one of only a couple of models, and these are not accurate quotes. These are models. These are projections based on data that comes in. So you have the Atlanta Fed has their GDP Now forecast. The Fed Bank of St. Louis and New York have what they call nowcast models, which are a little bit more static and often produce different results. So according to the Atlanta Fed GDP Now forecast, as of April 1st, GDP in the first quarter is projected to decline by an annualized rate of 3.7%. So that is a huge number. That is a big red flag, but that also calls into question exactly the data when it rolls in and how it is calculated. For example, the same week, CNBC polled 14 economists, and collectively, they're predicting first quarter GDP growth of 0.3%. So we're talking negative 3.7, 0.03% positive growth, obviously a wide delta. And really what's causing that is the Atlanta Fed's model literally runs off as data is reported.
Right.
So every time a new piece of data is reported, it's plugged into the model spits out new numbers. If you have big positives, big negatives, big underlying issues, that can skew the model. I don't expect first quarter GDP to come in at negative 3.7%. I could see it flat to a little bit positive. And really what's driving that, you alluded to, is there is so much uncertainty right now around the tariff situation. Today is April 2nd at 4 p.m. President Trump, he's called it Liberation Day, is expected to announce a full round of formal tariffs. And really where that is coming from is the U.S. has trade imbalances with most of our trading partners. And on the face of it, you say, well, that's because we buy a lot of goods from foreign countries. But there really are unfair trade practices out there that are damaging U.S. consumers. And the Trump administration is really just trying to right-size these things. This is obviously a fluid situation. We already saw this morning that Canada has proclaimed that they will remove any retaliatory tariffs against the U.S. if the U.S. pulls back tariffs on Canada. So every day we're seeing new information. We're seeing threats of tariffs being pulled off. Until this is really concrete, we're not going to know. It's going to cause a lot of headline risk. It's going to cause numbers to jump all over the place. I think fundamentally the U.S. economy is slowing. Inflation is coming down. Jobs remain strong. In this tariff situation, it's going to be a little bit of a wild card.
Well, and the reality is just because today is Liberation Day, nothing is ultimately solved today. I think some of the questions will be answered, but it's going to continue, as Cameron says, it's going to continue to be fluid. And kind of back to the GDP numbers, we talked about this last month because Fed GDP Now is kind of lifetime data. Already they were projecting a negative first quarter because when you bring a lot of imports in, that reduces GDP. So there has been a lot of importing prior to the tariffs. We knew these were coming, which puts a big negative number on GDP. Once those imported goods are sold, they are brought in, they go in an inventory, that reduces GDP. But once they are sold, then it comes back into the GDP number on the positive side. So what the actual effect is without the imports, it's gonna be hard to say. I mean, we're not really gonna have a good feel for economic growth until well into second, maybe third quarter, where how much slower is the economy growing versus the 2.8% last year. What is it going to look like this year? I've seen a lot of different projections on the effect of tariffs, all the way from 0.4%, which is basically kind of what's being baked in right now for annual growth,
Hmm.
to as high as 1%. So we could be seeing GDP this year in that 1 to 2% range. The expectation is that it'll be positive. It's just, how is all this stuff going to coalesce and come together is really hard to say.
And to your point, we're not going to really know anything until
Right.
we get through
One
at least
interest,
several quarters.
yeah. We're gonna turn to the markets now, but the reality is where we've seen the most pain in the market has been in really the largest stocks that compose the S&P 500, the Nasdaq, more your mega cap tech stocks, and those have struggled. The Nasdaq is down 10% for the year. The S&P 500 has flirted with a 10% correction, and a lot of that is being driven by those tech stocks. I ran across an interesting piece of information last week, and really, U.S. production grew 0.7% month over month in February versus the estimate of growth of 0.2%. So 0.7%, that doesn't seem like a lot, but the reality is industrial production also made an all-time high for the first time in 76 months, dating back to September 2018, which was the third longest stretch without a new high since 2019. That comes from the U.S. Fed Reserve, and there's actually other stuff happening besides AI and tech,
Yeah.
and we're actually starting to see, maybe, is that anticipation of tariffs now, or could this be a result of stuff that was done 5 years ago, 6 years ago, encouraging more onshoring of production? We'll see, but that is, there are some positive things going on in the economy.
Well, and to that point, we've already seen well over $100 billion of commitments from manufacturers to bring production, both jobs and physical production facilities back to the U.S. because of the Trump administration's America First policy. And, we're talking potential of hundreds of billions to even $1 trillion of new investment in the U.S., which will certainly drive jobs, will drive productivity, will drive the economy. So again, a lot is going on, and you can't put it all together into one number right now. It's going to be a very fluid situation.
Absolutely. So with all this uncertainty, in March, the S&P 500 was down 5.75%, the Dow down 4.2, Nasdaq down 8.2. Small cap stocks, which had a great year last year, were down 7% for the month. International markets, the developed world, EAFE, which really had held up really well and was kind of leading the pack, relatively speaking, return wise, was down 1% for the month. Emerging markets was down 0.4. And on the bond side of the equation, the Bloomberg Aggregate Bond Index was actually up 0.04%. Year to date, the S&P is now down 4.6% through the end of the month. The Dow down 1.3, the Nasdaq down 10.4. So once again, anything that's tech heavy has been hurt the most. The Russell 2000 down 9.8 for the year. The EAFE actually still up 6%. Emerging markets up 2.4%, and the bond index up 2.8%. So bonds have been a good place to actually hide out, if you want to call it. They're actually making decent returns. It's not just preserving your money like it was 5 years ago. Now we can actually make a little bit of money in bonds. Our portfolios, growth with income portfolio, which is more of a balanced portfolio. For March, we were down 1.4%. Year to date, we're hanging on to about 3% gain. Big winners there. Gold up 9.5%, and we've been seeing new highs in gold in recent days. Exxon up 7%, and our all-weather commodity fund up 5%. Laggards for the month, Nike down 20%, Microchip down 18%, Nvidia down 13%, Disney down 13%, Apple down 9%. No, I'm sorry, down 8%. Year to date, gold's the big winner, up 19%. Berkshire Hathaway up 17.5%, Raytheon up 14.5%, Exxon up 11%. And once again, all-weather commodity fund up 9%. The big laggers, this is what's detracting from our performance. Nvidia down 19%, Iron Mountain down 18%, Nike down 16%, Disney down 11%. So kind of a mixed bag, but more winners than losers, so that's working there. Our dividend yield portfolio, which historically has been our most defensive portfolio, in March gained 1%. Year to date, still down 2.5%. The reality there is, if we are going into more of a stagflationary environment, meaning slower or no growth plus inflation, they call that stagflation. Really, your dividend yielding stocks do the best, or anything producing income tends to do the best. So year to date, we're down 2.5%, but the other side of the coin in dividend yield is we hold a lot of multinational companies. So just the
Tariff threat.
Yeah, the threat of tariffs has definitely pushed down some names that if we weren't in the tariff situation, I think it would be doing a lot.
And obviously, when you're looking at returns, you're looking at stock prices. But this is nothing fundamental about those companies. It's just about the situation.
Oh,
It's about the
absolutely.
headline. It's
Like I
about
said,
stock prices being unnecessarily impacted.
I think it would be leading the pack if we didn't have the tariff situation. Gainers for the month: Chevron up 5.5%, AT&T up 5%, American Electric Power up 5%, Duke Energy up 4%. So all pretty defensive names there. Laggards: Target down 16, obviously affected by tariffs. T. Rowe Price down 13, U.S. Bank down 10, Hewlett Packard down 10. Gainers for the year: AT&T, big winner, up 24%. All the years of it doing nothing. It's finally working.
Up there.
Amgen up 20%. American Electric Power up 18.5. J&J up 15. Big laggers year to date: Target down 22, T. Rowe down 19, and then HP's down 15%. Appreciation with income, year to date up 2%, but March definitely took it on the chin, down 3%. Gainers: AES up 7, Cigna up 7, Kinder Morgan up 5, Valet up 6. Our laggers for the month: Broadcom, once again, our tech name, down 15, Meta down 14, Eli Lilly down 10, Bank of America down 9.5. Our gainers for the year: Cigna's up 19, Valet's up 13, Pinnacle West up 12, and Equitable up 10. Once again, laggards, more tech names: Broadcom down 28, Microsoft down 11, Brink's down 7, and Energy Transfer Partners down 5. Our price potential portfolio, which is our most aggressive and right now probably has, across the board, maybe our most exposure to the big tech names, down 6% in March, year to date down 6. Our gainers in there: McKesson up 5, Yum China up 5, and Global Life was up 3%. Laggards: Jazz Pharmaceuticals down 14, Nvidia down 13, Amazon on 13, Dell down 11. Year to date, McKesson's our big winner, up 18%, Devon Energy up 14%. Nvidia, for the year, down 19, Google down 18, Dell down 21. Small cap portfolio: last year we had a pretty good year in there, but obviously with all the volatility, small caps are feeling it. March we're down 6%, year to date we're down 11. So we're actually lagging the index. Rarely does this portfolio lag the index, but it'll come back. It's volatile. March, ProAssurance up 49%. That was thanks to a 45% pop in one day. They're getting bought out, so that was a nice buy, and we've held it very short term. Village Supermarket up 21%. Palomar Holdings up 7. Downside in March. Stratec down 21, Kyndryl down 18, Ligand up down 14. So some big losers there. Year to date, the big gainer is actually Village Supermarkets up 19. I'm not sure why ProAssurance wasn't in there. They're probably up year to date the most. Laggers for the year: Perma Pipe International down 17, Farmers Merchants Bank down 19, and Knife River down 11. So it's been a choppy month. Unfortunately, I think there's more to come. We are finding some winners out there, kind of keeping us better than the averages, and that's going to kind of be the goal. Stick with good quality. Will work in the long run, and
quality's going to work.
That's what's going to work now.
As you said, I think the story of 2025 is going to be volatility.
Absolutely.
Let's face it, we have an administration today that is radically changing course from what has been historically. Presidents have a lot of effect on the world, the economy, but traditionally you don't rock the boat the way the Trump administration has rocked the boat. Whether it's Doge, whether it's the tariffs, whether it's executive action, I'm not going to get into politics.
Well,
But the administration is making sweeping changes that they think need to be made because we really have had kind of 40, 50 years of status quo, of government running amok, government getting too big.
well,
And
part of it too, I think you want the good news first or bad news first. And I think what's happening is we're getting a lot of the more economically challenging actions are being taken now. But
he's ripping
so
the Band-Aid off.
well, yeah. So the most challenging economic situations are happening now, whether it's tariffs, job cutting, and so forth from that front. But the focus is going to change to one. The Fed has room to go from a loosening of monetary policy, bring down rates. That'll be a big positive. And then the next thing on the agenda is going to be, what's going to happen from a tax standpoint. How many? Are the tax cuts going to be extended moving forward, or will everything revert back to where we were in 2015? Or will be a combination of something. I think it's going to be a combination, but for the most part, I think taxes will remain fairly neutral, which that'll be positive. So there are some positive things that are coming later in the year, but that's, the market likes to focus on what's happening now. The media is going to focus on what's happening now. So that's why things are going to be volatile. And if anything, cool down as we get later into the year.
Yeah, I mean, this is all if you could take a military look at it, like a raw recruit going into basic training, this is tearing you down to then build you up.
Exactly.
Kind of situation. So the Band-Aid has been ripped off. A lot has happened, way more in the first 100 days than we've probably ever seen, at least in modern history. So expect volatility. By and large, we feel really good about our portfolios. Again, it's a focus on quality, companies that have a reason to be here, that are producing strong cash flow, companies that we expect to be more valuable next year, the following year, the year after that. When their fundamentals change is when we change. So, hang on. There's going to be volatility. If you have any questions, if anything's changed in your financial situation, please feel free to reach out to us. As always, we appreciate your trust and hope you have a great month. We will talk to you again in about 30 days. Thank you.
Thank you.